It's not always about getting the highest rate of return. It's getting a reasonable rate of return for the amount of risk that you're taking on.
Welcome to Multiple Perspectives. I'm David Lofgren. Today we're tackling one of the most overlooked aspects of commercial real estate investing, tax strategy. For many high-earning professionals, the appeal of real estate syndication goes beyond just returns. It's about the potential tax benefits that can shelter income and build wealth more efficiently than traditional investments. But there's a significant gap between what's theoretically possible and what investors actually capture without proper guidance. Joining me today is Thomas Castelli, a CPA and real estate investor, who's spent years helping LPs or limited partners navigate the complex tax landscape of commercial real estate investing. Thomas brings a unique perspective. He's not just advising on tax strategy, he's actively investing as an LP himself, giving him insight from both sides of the equation. So from depreciation to cost segregation studies to the nuances of debt versus equity investments, Thomas has seen firsthand how the right tax approach can dramatically impact your investment returns. In this episode, we'll explore how depreciation can create tax losses while you're actually earning positive cash flow, the crucial differences between investing through retirement accounts versus personal accounts, and why understanding special allocations can save you from costly mistakes. We'll also dive into Thomas's own evolution as an investor, including his sort of buy box strategy and lessons learned from diversifying across sponsor and asset classes. Let's get started. Thomas Castelli, welcome to Multiple Perspectives.
Thanks for having me, David. It's an honor to be here today.
When you first started advising LPs, in alternative investments in commercial real estate, I'm wondering if you could just talk a little bit about sort of what stood out to you in the gap between the potential tax benefits of this type of investing and what you were actually seeing on the ground, like what investors were actually able to capture without advice or without sort of the depth of knowledge that you have.
That's a great question, because the potential and the actual are, for LPs, can, if done right, or like it can be the same, really, at the end of the day, because it's not overly complex. I think there's often more like a misunderstanding of how it works. So let me break this down. So the U.S. tax system, earned income, so income from a job or a business, is taxed up to 37% at the federal level. Then you usually have state taxes if you live in a state that does have taxes, and then income taxes, that is. And then there's also FICA, or the self-employment tax. While often a very necessary form of income, it's not the most efficient. Whereas when you're investing as a limited partner in a real estate syndicator fund, or just in alternative investments in general, these are taxed as a partnership. And really interesting thing about that is what you're going to have a real estate. Let me back that up. You're going to have an expense called depreciation. And depreciation is a non-cash expense that really only exists on paper and is intended to kind of track the deterioration of the building over time. However, while you do have a depreciation expense, real estate tends to appreciate in value over time. So this depreciation expense can help you shelter your rental income from tax. And in many cases, thanks to things like 100% bonus depreciation and cost segregation studies, and we could dive more in and unpack that. But long story short, you're often going to have substantial depreciation expenses, which lead to substantial tax losses. So these do a few different things. So first of all, you're telling the IRS that you're losing money. You're saying to IRS, hey, I had a loss on my rental business or my investment in a syndicate or fund, despite the fact that you may actually be generating positive cash flow. And that's relevant because, again, if we go back to earned income, it's taxed at that 37% level, plus all the other taxes I mentioned. Very difficult to shelter that income from tax. Meanwhile, rental income is also taxed at those same rates. They don't have FICA tax or self-employment tax, but you still have federal and state income taxes. But thanks to depreciation, you're sheltering that. So oftentimes, the first benefit is that you could be generating positive cash flow, but telling the IRS you're losing money, and you're not paying that 37% rate or whatever your tax rate is on that level of income. So that's kind of the first tax benefit that is possible, and that most people end up enjoying who do invest into a limited partnership.
That's right. I know from speaking with our investor relations team that sometimes investors will call us after their first year K1s show up and they go, I'm nervous because it shows on the document here that I lost money. And we have to sort of take the time to go, well, this is actually a tax benefit that you'll be enjoying because of the fact that you're investing in real estate for the first time.
Right. Absolutely. There's a question that a lot of times is like, well, Tom, why would I want to take a loss on my real estate? And the reality is you don't want to take a loss, an actual loss, right? But oftentimes the loss exists thanks to depreciation, which is just on paper. And not only, again, the first benefit is the ability to shelter your rental income. The next benefit is if you have these losses that are in excess of the rental income or the passive income that you're generating in any given year, these losses just don't fall off your tax return and disappear. They get carried forward the future years where you can use those losses to offset future rental income. That's another benefit. And also, when you sell the property, you're typically going to have capital gain. A capital gain, ideally, if things went the right way, and also depreciation recapture, which is a tax on the depreciation you did take. But these losses can help offset that as well. So I guess what I'm trying to, the point that the potential benefit here is if you were to continue earning money through your job, it is taxed, it's inefficiently taxed, but it is often necessary. Whereas when you're investing in these limited partnerships and syndicates and funds, you're getting these tax benefits that are passed through to you that are sheltering your income from tax, and you're not paying those high rates. It's like the first major benefit of investing as an LP.
Sure. I wonder if you could talk a little bit about, so, at least on our platform, we offer equity investments for our investors. They end up becoming limited partners, LPs, in these investments. But we also offer debt investments. And for many of these, they actually receive a 1099 rather than a K1. Can you talk about sort of the difference in tax strategy depending on where in the capital stack you're plugging in as an investor?
Yeah, that's a great question. So, debt, when you're typically, the rental income that can be sheltered by depreciation, 'cause that's considered passive income. Now, debt, the interest, that's the income that you're receiving. Interest is not considered passive under the tax code. There's a specific carve out that says that interest is not passive, long story short. And so that's taxed at up to 37%, right? And plus your state tax return. So that you need to be a little bit more strategic if you're looking to shelter it. A common way to shelter debt is by investing in self-directed retirement accounts, because interest, is generally exempt from taxes. So you might invest through a self-directed IRA or self-directed 401k or solo 401k, because debt can be sheltered in those vehicles. Now, the other way to do it would be to qualify as a real estate professional or something along those lines, which is often not the case when you're doing passive investing. That could take losses from your rentals that are typically passive and be used to offset, and you can use them to offset the interest. However, again, that's atypical as a passive investor. So really know that if you're investing in as an equity investor and you're investing in a rental property of sorts, that you're going to have typically greater tax advantages in a non-taxable account, so just in your personal name or through a regular old LLC. Whereas with debt, you don't get those same tax benefits. And those, if you do want to enjoy greater tax benefits, you have to be a little bit more strategic. And in some cases, it does make sense to invest in those through those retirement accounts.
Right, and so that would be like a Roth IRA or something that's like shielded from actual tax after you've put it into that account, correct?
Exactly. So with the Roth, you put the money in after tax, so you pay taxes on it, and then you put it in, and then the investment itself is typically tax free within those accounts.
Right. Yeah, it's the sort of protected little world of investing. I think there's, as you mentioned, if you're a professional real estate investor, you benefit from a certain sort of set of tax benefits. But as passive investors, as folks who are just sort of looking to expand into commercial real estate, maybe for the first time, maybe they're doing that through their 401k or IRA, but maybe they're just doing this sort of with some extra income that they're trying to figure out, how to sort of access a bit more alpha than they can just through standard 60-40 portfolio allocation or whatever. You don't have quite as much power when it comes to, let's say, negotiating the structure of a deal. If you're going in as an LP and you're one of 99 in an investment, oftentimes you don't actually get to be at the table while that deal is being structured. I wonder if there are ways that you can help investors frame how they should think about how these deals are structured or what they should look out for, as you're reading through an offering memorandum, as you're trying to understand how do I sit with regard to my rights and the potential outcomes from these deals? Are there things that you think that investors should look out for or sort of hope for? Is there a checklist that they can go to?
Yeah, or from like a tax perspective or just a general investing perspective?
Well, let's do one then the other.
All right, so let's look at an investment perspective first. So I do invest as an LP. I'm in multiple syndicates and funds and have been investing for like the last 10 years, basically this way. And the first thing you want to do is the sponsor is of, and I'm sure this is cliche maybe on this show, but the sponsor is of the utmost importance. You need to make sure that the sponsor has a track record of success in the investment that you're doing. Because at the end of the day, they're going to be the ones making all the decisions and calling all the shots. And that's critical. I'm not going to go through any names here, but I've invested with numerous sponsors, and some of them who've not been through so many cycles made some mistakes, and other ones that have been through a number of cycles did not make those mistakes, and their investments fared better. And the difference was not necessarily the deal. The deal was the deal, but it was the operator or the sponsor themselves. So really the first thing I do whenever I'm investing is this sponsor, have they been through multiple cycles? How have they performed through multiple cycles? How are they currently structuring the deal to perform in the current cycle or the stage of the cycle that we're in? So sponsor is absolutely critical. I cannot say that enough. Don't let the herd do the due diligence for you. That could land you in some trouble. Do definitely do your own due diligence and get comfortable with it yourself. Now, if you hear bad things about a sponsor, it's usually a red flag and you should probably maybe steer clear. But if you're hearing good things, that's a good sign, but maybe not always. So again, do your due diligence on the sponsor. Also, one thing I would say too, and this even goes before the sponsor, in my opinion, is you need to know what you're looking for. What's your investment criteria for you as the investor? What are you looking to achieve from these investments? Are you looking to achieve growth? Are you looking for a value-added project that is going to maybe be light on cash flow throughout the life of the deal, but it's going to have a bigger equity multiple or a bigger pop towards the end? That's important for you to know because there's going to be a tremendous amount of deal flow that you can generate quite quickly. And it's important to know, okay, if I'm looking for growth and I want to grow my capital, then maybe a cash flow deal or a deal that's structured more for cash flow is not the ideal investment for me, and I should weed those out. And I can go into there's more details than that, but the point is you want to know what your buy box is. Long story short, you want to know this is what a good deal looks like for my current goals, my risk tolerance, and then filter through deals and opportunities that fit that buy box, because you could have a great sponsor and a great deal, but that might not be the best deal for you. So that's the first thing is, in my opinion, is having your buy box, knowing what you want, then vetting the sponsor and make sure the sponsor's good and the deal fits your buy box. Those are kind of my top things that I look out for from a investment perspective.
Right. Okay. And so then from a tax perspective, are there certain ways that deals are structured that you look out for? Is it all kind of the same? How do you advise people to think about, if they're going into these investments thinking, I want to make sure that I'm doing all of the smart things I can to try and gain as much, sort of tax advantage as I can. Are there tripping hazards? Are there any things that people need to look out for?
Yeah. I would say that you definitely want to look at what the sponsor's plan is for depreciation, right? And I'll start with this. Most of the time, you're going to see a cost segregation gets performed on the property. But a cost segregation study, so when you buy a rental property, whether through syndicate or fund or what have you, if it's residential, it's going to be depreciated over 27 and a half years. If it's commercial, 39 years. That's a pretty long time period. What a cost segregation study does is it breaks down the components of that specific building into different class lives, depreciable lives. Some of that property is going to have a depreciable life of 5, 7, or 15 years. Now, that's under just normal circumstances, those are depreciated faster over a faster period of time, and thus you'd have a greater depreciation expense than that 27 or 39-year property.
Can you give us an example of sort of what might fit into those different sort of time frame categories?
Yeah, absolutely. So 5-year property is tangible personal property. Those are going to be things like appliances, certain fixtures, carpeting, things that are typically not permanently affixed to the building. So that's typically what you see. Then you have 15-year property, which is more common. Like 7 years, kind of a catch-all bucket. I'm not going to go too deep into that, but 15 years is land improvement. So those are things like pools, decks, landscaping, sheds, underground plumbing systems, things of that nature. The cost segregation study, what that does is it breaks all these down, and then you could 100% bonus depreciate everything that's under 20 years of class life, which is typically that 5, 7, and 15-year property. And you want to make sure typically that they're doing the cost segregation study. Most of the time that is to your advantage to take the depreciation now and use it to offset the income that might be generated from that investment or other investment that you're invested in. So that's the first thing. The second thing is I would watch out for as an LP, I would watch out for special allocations. So typically in a typical deal, income, losses, deductions, et cetera, these are all going to be divided by your ownership percentage. So if you own 1%, you get 1% of the income, 1% of the losses, so on and so forth. Now, there are some cases where the sponsor, you can do this in a partnership. You can specially allocate certain things. So sometimes you might see deals where all the depreciation is allocated to the LPs and not anything to the GPs. Other times you might see vice versa, right? To just draw some extremes or anything in between. So you want to understand how this depreciation will be allocated. And if there is a substantial amount going to the sponsor, that would be different from their ownership percentages. You want to understand why that is, because you as the LP, you're the one with the capital. You're the one you're risking your capital, and you should be the one receiving the benefits of that depreciation expense. So that's more of like a red flag to watch out for. And I'm not saying it's too common, but it can happen if you're not paying attention. So it's just something I would keep an eye out on.
Interesting. Okay, so cost segregation and then special allocations. Is there anything else that you tell people to look out for?
Yeah, I'd also keep in mind how you're investing into the deal. If you're investing through a self-directed IRA or 401k and you're investing in a real estate syndicate or fund, there could be additional taxes that you're not that if you're new to the game, you might not be aware of. So to give you an example of what that is, so there's something called unrelated business income tax. And this is most of the time generated by something called UDFI, unrelated debt financed income. And basically what it says is that if you invest in a rental property and it has a debt on it, because it's in an IRA, because you're generating part of that return or part of that income using debt financing, that we're actually going to tax you on that. So usually when you if I buy S&P 500, just for example, in an IRA, the dividends, the gains, not taxable. But if I invest in a syndicate that buys multifamily property that's leveraged by debt, now I might be subject to this unrelated debt finance income. And that's something to be mindful of when you're investing in, and it's specifically an IRA. With 401k, you're typically not going to be subject to that because they're actually exempt from UDFI or from this tax. But from an IRA specifically, you could be subject to that tax, and just something you want to be aware of. So what I prefer in most cases, what I prefer to see investors do is invest in their syndicates and funds in non-taxable accounts or outside of their IRA, because again, this investment can be tax sheltered, and your ordinary income, your interest, your dividends, when you invest in your taxable accounts or outside of your retirement accounts, those forms of income can be difficult to shelter from tax. Meanwhile, real estate is easier to shelter from tax through when you're investing as an individual, not in your IRA. So put your LP investments, if you can, in your personal name. Put your interest or your investments are going to generate interest or dividends in your retirement accounts where they're sheltered, because people are often surprised to hear that, what do you mean I invested in the syndicate or fund in my IRA and I have this tax that I wasn't aware of? So that's just something to watch out for, is that UBTI tax. It's not the end of the world. I'm just making you aware that it exists.
Sure, yeah, and you want to be able to, even if you're going to get hit with that, you want to know that before tax time, right? I mean, it's nice to sort of know what you're getting into at the top, especially if you're trying to figure out, calculate what your potential returns might be. That sounds like an important thing to keep in mind. A minute ago, you said something that, I'm excited to be talking to you because not only are you, a CPA with experience helping investors who are LPs, GPs, folks who are actively engaged in commercial real estate investing, but you are also an investor yourself. And so you've seen sort of what it feels like to be on both sides of the table in this context. And a minute ago, you mentioned that as far as investing strategy is concerned, that it's really important to know what your buy box is. And that's fascinating to me because oftentimes we hear sponsors talk about what their buy box is. They'll say, listen, we work one specific type of business plan. We know exactly what we need the asset to look like and the conditions of the local market. And, they'll sort of have this very specific, like, we'll just be patient until the asset comes along that matches our buy box because we're confident that we can sort of execute this business strategy over and over again. But you're talking about developing a buy box as an investor. And I'm wondering how you frame the sort of decision-making process to develop your buy box. Like, how do you figure out what is the thing that I'm looking for? What is the sort of financial play that I'm hoping for when I'm taking on an LP position? So can you talk about just sort of how you frame that for yourself and how investors might frame that for themselves?
Yeah, I think the first part is you'd want to start with like, what is your intention? Or what the way I did it was, what was my intention for this investment? Like, there's a ton of opportunities that came my way. Some of them had preferred returns of maybe 10% that were a little bit more cash flow oriented and more limited on the potential upside or on the amount of growth of the equity. So they're more cash flow oriented. Then you might have some that are interest, that are not equity, but are interest oriented, and that's mostly income focused. And then there's also then investments that are value add or opportunistic, where you may not have much cash flow during the life of the deal, but you have a much higher upside on the exit. So that was kind of the first thing for me, because I realized I had made an income investment. And I said to myself, why did I make that? And I made that because at the time, that was an investment that was available to me and made sense. But then as I kind of thought about it more and more, I'm like, I'm in growth mode right now. I'm trying to grow my capital base. And because I had made that investment, there had been an opportunity that came across my desk, so to speak, not too far later on, that made much more sense. And now that capital had been allocated to this more income-oriented investment when I was really looking for growth. So that's kind of how I came to the kind of realization. Okay, I'm in growth mode. If it's more income focused right now, I'm moving that into. It might be a good investment, might be a great sponsor, but you know what? I'm just not going to entertain that because that doesn't meet my buy box right now. It doesn't meet my investment goals. So that's kind of the first thing that I did. The next thing I did is I realized, okay, after investing through with a bunch of sponsors, I'm like, sponsor quality matters too. Are they just starting out? Is this their first syndication? Some people might be wanting to take that risk. I'm not at this stage. Then there's some who are professional, like professional sponsors who do this a lot, but they're a small shop. And then there's others who've been around for 20, 30 years, been through multiple cycles, have an investment company built out, an operation behind them. And that's kind of, became where I've started to gravitate towards. So that's become part of my buy box. Are they more institutional at that point? Now, that's not the only factor. I still invest with other people, but that's starting to become part of my buy box. And then, like, where's the rate of return that I'm comfortable with? And it's not always about getting the highest rate of return. It's getting a reasonable rate of return for the amount of risk that you're taking on. So I kind of said to myself, if I'm going to be taking on the additional burden of the additional risk of having illiquidity, going with a sponsor, or just putting my money in somewhere I don't have control, I don't have that liquidity, I want a certain return to make that worth it for me. So I set that number somewhere in the teens, and if it doesn't meet that criteria, then I'm just not going to make that investment. So from a high level, it's more detailed than that, but from a high level, that's kind of the three major things in my buy box: is investment strategy, where's it fit? Is it growth or is it income? What's the quality of the sponsor? And then what is the return profile? And does that profile meet the criteria that I would say this is worth me tying up X capital for however many years in an illiquid investment that I have little control or no control over? So
Sure. Sure. Can you expand on the last piece there? Like, I wonder, obviously, if you're aiming for deals that are going to target some sort of return in the mid-teens, you are making an assessment there of the risk and reward balance. This is, what we talk about in all sort of investing. What is the risk that you're taking on in order to try and actualize whatever these target returns are? How do you think about risk? Like, how do there are lots of folks who are doing deals out there who will say, we're targeting a 28% return and it's going to be great. How do you sort of think about analyzing the risk in a way that makes you feel comfortable putting your hard-earned money into these deals? Are there sort of good frameworks that folks can apply when they're thinking about the risk-return balance that they're trying to achieve?
Yeah, I think to some extent I'm still trying to figure that out, like hone that in myself, if I'm being honest. But I think it comes down to the sponsor. Has the sponsor been able to drive those types of returns before, right? Have they had the opportunity to achieve what they set out to, right? Like if they said that they were going to do a 20% return and they did 15%, well, and now they're telling you they did 28, for example, what are the odds of them? Like, so how consistent have they been at achieving the goals, the returns that they said they were going to do? That's, I think, the first part. And then the other part of it is, and I know you guys had Jeremy Roll on at some point, and I listened to that episode. It's phenomenal. Understanding where we are in the market cycle too, because one of the investments I had made a few years back was I thought we're at the very high end of the market cycle back in like 2021, and I'm like, interest rates can't be this low forever, so I'm going to go invest in a fund that ties the interest rates to the length of the deal to mitigate the interest rate risk. And it's just one example, but like just understand where you are in the market cycle and kind of trying to be a little bit smarter than the sponsor in the sense, or like, not, I don't want to say smarter than the sponsor, but just trying to also do your own conclusion. Like, can this return actually come to fruition? What are the risks that this might go wrong, right? What if interest rates shoot up? What if a bunch of supply comes onto the market? Now, I'm not saying you should go and underwrite the deal yourself. That's not your role as the LP, but just what are the supply and demand constraints? What are the other risk factors that could be coming up the pipeline that may prevent the sponsor from actually executing the return? So obviously, part of it is, do they have a track record of achieving the returns they set out to? But also just realizing the overall macro environment and perhaps even the local environment in which the deal is, whatever market it is in. Is there any headwinds that could prevent that from happening? Just being aware of that and keeping your ear to kind of the street of the market can help you kind of hone that in, if that all makes sense.
Yeah, absolutely. Absolutely. It's interesting. You're talking a bit about sort of the evolution of your own understanding as you invest, right? And I think this is something that individuals are, we're all sort of going through this personal evolution. The industry broadly is also going through this evolution. And I think, we're about 10 years since anyone really made any moves based on the sort of evolution of regulations that the Jobs Act brought forth, right? That's allowed us to set up crowdfunding for commercial real estate. And so, we're a decade in. We've been through some of the most tumultuous financial economic realities that any of us have ever lived through in that last decade. Do you, as a CPA, as an investor, as someone who's sort of deeply steeped in this business and this market, do you feel like collectively we're learning things, that there have been sort of lessons or a deepening of understanding that LP investors are gaining? How has that evolved over the last decade in your eyes?
Yeah, no, it's certainly there certainly is a collective wisdom that's being generated, and the tone is shifting within the LP community. There's a lot of communities out there for limited partners, and I've seen that shift. I think people are starting to shift towards more understanding how much I'm trying to articulate it, because it's a little bit vague in my head, but I know what I'm trying to say. So they're a little bit more keen on who the sponsor they're investing with is. They're a little bit more keen on understanding where we are in the market cycle. I think that's important these days. and also just vetting out more of an understanding in general that there's a tremendous amount of risk, and like how do you vet sponsors to mitigate that risk? How do you weed out the bad sponsors from the good sponsors? I think there's a lot of communities that kind of vet that out at this point, and there is a collective wisdom being generated around that element of it as well as others. But I think the sponsor vetting has definitely, I've seen the community do a lot more sponsor vetting and become a lot more skeptical of some of the promises out there. That's for sure happening.
Yeah, I mean, it's interesting, as you said earlier, there can be this feeling like, am I supposed to underwrite this deal myself? If I'm going to put 10 grand into this investment, does that mean that I need to like take the time and do a complex underwriting without maybe any of the expertise that goes into sort of doing an institutional style underwriting of a deal? And one of the things that I think we've found both internally in the company as we look at the numbers and as we speak with our investors and the community of folks who are so actively engaged in commercial real estate investing in this way is that diversification can, of course, it's like the most basic concept in investing, but it's hard to keep in mind sometimes when you're spending a bunch of time and energy looking at a deal to remember that this is not the end all. This one deal is not the end all be all. And that for any of the platforms, for any of the sponsors that have, a good reputation, their reputation is not necessarily built on how one deal fared, but rather what their sort of aggregate return is, what it looks like if you actually are able to both, time average into the market swings of commercial real estate, and also sort of put your eggs in many, many different baskets. And I'm wondering how you think about diversification in your portfolio or for the clients that you work with. How are you trying to sort of mitigate some of the risk that comes with inherently, potentially giving some of your money to a sponsor who's across the country in a market you don't understand, and, an asset class that you think this seems like a good idea, sort of gut check, it feels good, but who knows? None of us can predict what's going to happen in the next 6 months, in the next 2 years, or whatever the term of the deal is. Like, how do you apply the idea of diversification to a commercial real estate investing approach?
Yeah, so I think the first thing is sponsor diversification from a high level. Don't want to put all your eggs in one basket, even if they have performed really well. So I think from like, not to contradict myself there, but the way I do it is like this: is like I'll invest with a sponsor, and I'm gonna wait for them to go full cycle. I want to see what that deal. I'll do all my due diligence. I'm gonna bet that their past performance is going to, that based on their track record, they're going to continue to perform. And obviously that doesn't always happen, but I'll put my money with them and I'll say, let's see how they perform in this investment. And if they do good, then I'll probably reinvest with them. But I'm not going to I'm not going to continue to invest in multiple deals with the same sponsor until they start coming to the fruition. So what I like to do is do like a good amount of research on a handful of sponsors that I feel are strong, and then I whittle it down based on all the factors and say, okay, here's a handful that I'm going to go deeper on, and then I'll place my bets based on that, and then wait to have it go full cycle. So I don't like to make multiple investments with the same sponsor until they come full cycle, and that's kind of how I hedge my bets. It's like, if I'm going to make, let's say, 3 investments, for example, they're going to be 3 different sponsors, unless one of them went full cycle and I still believe that they're going to continue to do well. Then maybe I'd reinvest with them. But yeah, I would not put all your eggs with one sponsor. I would not over allocate into any one deal in the first go round. So for example, if the minimum is $50K, right? I might not go put 100 or 150 or however. I'm just saying in general. With that one sponsor, I'm going to take my capital and allocate it across. So that's kind of how I look at diversification. Sponsor diversification first and foremost. One thing I think overdo was allocations to different asset classes. I think it's kind of important to maybe have a few different asset classes in there, but ones that you do understand. Like, I invested in one asset class, and I'm not going to name what it is because people probably know what it is. But I didn't really understand that asset class so well. But so many people had invested in that and came highly recommended that I made that investment. Because I didn't understand the risks, it ended up going bust. And I asked myself, well, how did I find myself in this situation? And the reality was I did not understand the asset class so well, and I did not see what could be coming up for that asset class, and that's what shot myself in the foot. So when it comes to diversification, I think sponsor diversification is key. Asset class diversification can help, assuming that you understand the asset classes that you're investing in and the playing field and the risks of those specific asset classes. And then, of course, markets. Probably makes sense to diversify there too. I know I have. I invest in a lot of funds who may have assets in different markets, so I'm not in any one given market because, if you're in a concentrated market and something goes south in that specific market, and all your investments are in that market, well, then you just, you can get wiped out. And so that's how I kind of look at diversification. I think it starts at the sponsor level and also the asset class.
Interesting. Yeah, it's been fascinating to sort of watch the evolution of this industry over the last decade, and clearly you're deep in the weeds of it, both as an investor yourself and as someone who's helping investors understand how to approach investment from a tax perspective. But this isn't the end, right? We've got a whole world of new regulations that just came through with the passage of the Big Beautiful Bill. And I'm wondering if you have a crystal ball on your side of the computer there, how you're thinking about the evolutions in commercial real estate investing, specifically as it pertains to LPs, self-directed investors, this sort of retail investing approach. What do you think the future holds for us? What can we look for in the next few months, few years?
Yeah, that's a good question. I think it's going to. I've been trying to keep an eye on different asset classes, and in general, just high level with the passage of the One Big Beautiful Bill, 100% bonus depreciation did recently return. So I expect there to be. We're already seeing it from the CPA firm perspective, a demand for real estate. And capital flowing into real estate. So that's just something to keep in mind. There's going to be a lot of capital chasing real estate. And that could have various impacts. I think we need to keep an eye on interest rates too, and the way they flow. If interest rates decrease, there's going to be some more activity going on, I'm sure, with people getting in there. So I would be keeping an eye on the closest thing is probably interest rates right now. I think the tax landscape is pretty well defined, but the interest rates and how that's going to impact things as well as supply and demand. Like, for example, I know in the multifamily space, which I've been following for 10 years, right now, the market, due to the rapid increase in interest rates over the last few years, people have went underwater and some people have to sell their deals. And, there's also been some supply that came onto the market, and people think in the next few years it's going to be a good time to jump back into multifamily, but it's not right now. And yeah, so I guess what I'm trying to say to articulate this is I would expect interest in this asset class, in syndicates, in funds, to continue to evolve due to the tax benefits that are associated with them. And it's really then looking at knowing that the tax benefits are going to be there if the deal is structured properly, as how do you know when to invest? And that's really the question, and what to invest in, and interest rates and supply and demand. And also just general trends in demographics are going to help you understand where to place those bets.
Fascinating. Well, I hope we can have you back on the show in 6 months and see how it's all unfolded. Thomas Castelli, thank you so much for joining us on Multiple Perspectives.
Thanks for having me.
That wraps up today's episode of Multiple Perspectives. Thomas just gave us some great insight into tax-efficient real estate investing, revealing how the right strategy can transform your returns while the wrong approach can cost you significantly. His emphasis that the potential and the actual can be the same for LPs who understand the rules is the key insight every commercial real estate investor needs to internalize. This conversation feels like it highlighted a crucial reality. While real estate syndications offer powerful tax advantages, they're not automatic. Understanding depreciation, cost segregation, and special allocations isn't just helpful, it's essential for protecting your investment and maximizing returns. Thomas's warning about unrelated debt finance income in IRAs, could potentially save investors thousands in unexpected taxes, while his sponsored diversification strategy offers a practical framework for managing risk across multiple investments. Thomas's evolution from making investments based on availability to developing a rigorous buy box demonstrates the importance of having clear investment criteria. His three-pillar approach, investment strategy alignment, sponsor quality assessment, and return profile evaluation, provides a replicable framework for those of us who are building commercial real estate portfolios. The lesson that sponsor quality can matter more than the deal itself is particularly valuable in today's market environment. For investors ready to optimize their tax strategy while building wealth through commercial real estate, this episode provides the roadmap. Remember, the tax benefits are there for those who understand how to capture them, but only if you do your homework and invest strategically. Thanks for tuning in. Subscribe and share this episode with anyone who you think is ready to sort of take their real estate investment tax strategy to the next level. And we will see you next time on Multiple Perspectives.